Hello, everyone. Kathy Sedator, mortgage planner and proud veteran. What do homeowners need to know as mortgage rates continue to go up? Well, mortgage rates are over 2% from last year, and the decrease of new mortgage applications are down about 11%. So buyers, as I discussed yesterday, have to lower their expectations. However, they are raising their budgets to make sure, and please make sure, what is the highest rate you can be to continue to stay pre-approved, right? At the end of the day, it all boils down to your ability to make that payment, even if you increase your budget, right? So you pay off this kind of debt, you do all of this kind of things in order to ensure in this competitive market that you can stay a pre-approved buyer, right? So one of the things that is happening is many buyers are getting discouraged, disappointed, because they're losing on multiple offers that they have submitted. So have you considered becoming a cash buyer? Ask me how. I have another video to show you how to do that. One of the scary things, but a lot of what the media is talking about right now is ARM, adjustable rate mortgage. So we've spoken about, hey, the bubble that happened in 2007, 2008, and a lot of that had to do with financing, right? In regards to the ARM, the ARMs. The difference between then and now is that they qualified you on the current interest rate. But once the interest rate is increased, they did not let the buyers know. In today's market, if you did decide to get an adjustable rate mortgage, you would have to qualify for the higher rate to ensure that you keep your home. So that's a big difference in regards to what happened in 2007, 2008. I wanted to talk to you about the 30-year, the 15-year, and the 5-1-year ARM. So right now, as discussed, interest rates are over 2% from last year. You have a 30-year fix, and there's different types of loans, right? You have a 30-year loan, which can be conventional. I'm showing here there's a 30-year FHA, and MBA, the interest rates are almost about the same. Hey, did you know that 30-year jumbos? If you can see right here that jumbo loans, they have a lower interest rate, even though their mortgage is usually higher. How can that be? Well, most people who earn that kind of money don't want to pay a lot of interest. So the incentive to ensure that they do get a loan is part of the fact that they usually earn more money, they usually have more reserves, they're usually putting more money down, and hence they usually lower risk. And as a result, their interest rate is lower. Now let's talk about the 5-1 ARM, which means it is fixed for 5 years and then adjust 1 year thereafter. We just discussed before that the recession will be happening. When will it happen? When the Feds control inflation. Once inflation is under control, then we go into a recession. And then once we go into recession, interest rates usually decrease at that time. So you have to be very careful in what type of loan that you're going to get, right? Because you have, again, what is it? You have your credit, you have how much money you're putting, you have the debt to income, how much money you make, how much money you're spending to include the new mortgage, right? And when you boil all that down, all of that plus what's happening in the market, because a year ago, the rate was 2% lower, right? So that is really a big indicator of what's you as a buyer have to concern yourself with. So when we go to that, let's just talk about the difference between what's happening with the mortgage back and the treasury prices. Right now, we're using the 4% coupon. However, rates are still, as I showed you before, almost over 5%, and some in the 6%, depending on their interest rate, right? What is their interest rate based on? The credit scores, the debt to income, how much money they're putting down, the type of property, right? All of that plays a part. So right now, using this particular graph, once I get my new graph up, which I usually use MBS Highway, then we'll have a different conversation. But at the end, it all boils down to you as a buyer have to what? Interest rates are higher, home prices are higher, and hence you are paying more money to get the same house. Usually when interest rates go up, right, home prices usually go down. But this is a different type of real estate market. Why? Inventory is what's making the biggest difference. Once we get more inventory and you have more buyers who have choices on the homes they can make an offer on, then we'll see a difference in how the market's going to shift. I really want to note your idea with the ARMs, the adjustable rate mortgage, because for me, I understand it and I don't recommend it to a lot of people. However, depending on what price point you're at, if you're going to save that much money, then it might be reasonable to do, or you go with a 30-year fix knowing that there's so much unknowns that at least it's fixed for 30 years. Give me a call at 619-846-2675. Talk to you soon.